Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead at important events on the horizon. Let's start with what moved markets this past week. The theme running through all of it was balance, solid growth, cooling inflation pressure, and a market that's becoming more selective. The consumer story also stayed relatively strong, with June retail sales rising by 0.2% on top of an upwardly revised 1% gain in May. And once you strip out gas stations, the sales climbed a much stronger 0.7%. 7 of 13 retail categories posted gains, led by online retailers, autos, and electronics. Lower gas prices give households extra room in their budgets, and that money went straight into discretionary spending. The control group that feeds into GDP rose by 0.5%, so this is real, measurable economic growth. On inflation, the consumer and producer reports came in softer than expected, and investors responded by pulling back their bets on further Federal Reserve rate increases. That's a meaningful shift. It signals that growing confidence in current policy is already doing its job, and it takes a layer of uncertainty out of the borrowing costs for businesses and households alike. When rate expectations settle down, it's generally a healthier backdrop for both stocks and bonds, and it lets companies' fundamentals do the driving. Technology shares took a breather as investors reassessed how quickly all of this AI spending will show up in earnings. Here's what we'd point out. The broader market held up well, with most S&P 500 companies actually advancing, and the 4 largest AI operators are still expected to spend more than $725 billion this year. That's not a retreat, that's a conviction. Periods like this reset expectations after a big run, which is healthy, and second quarter earnings should give us a clear evidence of how those investments are converting into revenue. Now let's look at what drove our performance over the past week and why we remain confident in our current positioning. KKR was our top performer with an 8.2% gain. The firm made a series of announcements that reinforced its long-term earnings story. It launched Alintra, a new engineered solutions platform serving medical technology and precision manufacturing, and it announced a 400 million Australian dollar financing facility for Ampol. Both show a business that's actively putting capital to work across private credit and infrastructure. As one of the world's leading alternative asset managers, KKR benefits directly from improving private market activity and a healthier deal environment. Financials led our performance more broadly as capital markets strengthened and investors grew more constructive on alternative asset managers and investment banks. Firms with private market exposure benefited from expectations of better transaction activity, continued fundraising momentum, and steady fee-related earnings. Our exposure stays focused on businesses with durable cash flows, diversified revenue, and strong balance sheets, the kind of franchises built to perform through different market cycles. Our size strategy was the highest contributing style factor, with Meta platforms, Amazon, Apple, Nvidia, and Microsoft all showing solid gains. Mega cap leaders stayed supported by ongoing AI investment and resilient corporate spending. When valuations are elevated, institutional investors consistently gravitate towards companies with scale, liquidity, proven earnings power, and real competitive advantages. That's exactly the profile our size strategy is built to capture. Looking ahead, here are the key events that we're monitoring that could shape markets in the week ahead. Monday brings Canada's inflation update. The last reading came in at 3.2%, up from 2.8%, and almost all of that was energy related, with gasoline prices rising over 30% and broader energy costs up around 9%. The important detail is underneath the headline. The Bank of Canada's core measures held steady at 2% and 2.1%. And shelter inflation actually eased to 1.7%. That tells us that the pressure is concentrated in one category rather than spreading through the economy. Thursday morning's jobless claims report is one of the most timely reads we get on the job market. The latest numbers were actually encouraging. Initial claims fell by 8,000 to just over 200,000, which was the lowest level in over 2 months and well below the expectations of 217,000. Continuing claims dropped by 16,000 to 1,805,000. Low firing levels point to a labor market that remains relatively robust, and steady employment supports the consumer spending and corporate profits behind equity returns. Friday brings Canadian new housing price data, which tells us what builders are charging for newly built homes. The last report showed prices down 0.3% for the month and 2.4% below a year ago, with house prices only off about 0.4% and land-only prices down 0.3%. Easing new home prices improve affordability for buyers over time, and they help us read conditions across real estate, constructions, and the Canadian banks that lend into housing. As always, we remain focused on what matters the most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thank you for joining us, and we'll see you on the next update.